it seems like, I mean, I guess as a central bank, what's the quote? If all you have is a hammer, the whole world looks like a nail. And they really only have a couple tools. And really it's, monetary tools. And so that's kind of like interest rates and increasing the debt supply, the money supply. But with interest rates, I mean, they're already almost down to zero nominally. We can talk about real rates, et cetera, which I do want to get to. But it seems like a lot of those tools, they're basically running out of, right? Interest rates are down to zero, debt's at all-time high, economy's not growing, so the debt to GDP is tough to move. I mean, do you see that they're like running out of tools? I mean, like how much further can this can be kicked down the road?
So for the Federal Reserve, I do view them as towards the end of their rope in terms of tools. And so they really only have two tools at the end of the day. Mostly it's interest rate manipulation and asset purchases or sales in some
Mm.
cases. And they have some other tools around the margin, like lending facilities and things like that. But ultimately, it comes down to controlling the price of money and buying assets. Now, the fiscal authorities, they're the ones that they can say send cash to people, but then they have to issue debt to do it. And so you have kind of, I've described it as like, if you have like a movie where they're going to launch like a nuclear missile and like two generals have to like put their keys in at the same
Right.
time so I view policy tools and fiscal tools kind of like the two keys there when it comes to generating inflation. And so if you just have the monetary policy, that's not generally very inflationary on its own because you can't directly get money to people, right?
Right.
So the Federal Reserve can't send money to people. All they can do is control interest rates and they can increase the amount of bank reserves in the system, but then those get stuck in the banking system because banks aren't doing loans. And so you have reserves go up, you recapitalize the banks, but it doesn't actually get out into the public. On the other hand, the fiscal authority can send money to whoever they want as long as they have a consensus, but they have to issue bonds to do it. And then therefore someone has to buy those bonds, which sucks money out of the system. But
Right.
then if you combine the two and the Treasury sends money to people, they issue bonds, which the Federal Reserve creates new base money and buys those bonds and holds them forever. Well, then you're just literally essentially creating new base money and directing it into the economy. And that's how you get, say, the 25% broad money supply year over year change that we had, in 2020.
Yeah.
And so that tends to be a more inflationary environment, especially if they were to sustain it for several years. And so I think, as we go forward, obviously right now we're having some base effects, right? So in say March, April, May, June, you're comparing it to the 2020 period, which was like the kind of the disinflationary crunch they had during the worst part of the lockdown.